has had this problem for quite a while. And so, but I think what you're seeing in Europe is you're seeing, where did the problem come from? And the problem comes from fairly generous social programs, fairly generous compensation in the government sector. And this has been going on for year after year after year. So there's been a gradual buildup, I think, except in the 1990s when the debt ratio actually went down.
All right, so now that the mechanism when we say quantitative easing, basically it means that the feds buy bonds, is that right? And those bonds, because they take in bonds and they give out cash, it means there's more cash in the system. I've heard that the cash supply, that is the money supply, how many dollar bills we have floating around, in the last year or so has doubled. Is that about right?
What the Fed has done in this last period is they've essentially tripled their balance sheet, the monetary base, which is the source of funds that banks can use to extend loans, which ultimately increase the money supply.
Right, so what is the money supply? Oh, since Obama's...
The actual money supply has been relatively stable or stagnant. So one of the things that have led to there not being much inflation and not necessarily much kick from the monetary policy on stimulating the economy is it probably did what it really was planned to do, which was put a bottom to get people confident in the banking system again, keep their funds in there, and not lead to the types of collapses in the money and spending stream that we got in the 1929 to 1932. So to that extent, some of the early things that they did were effective from the monetary policy perspective in creating the bottom. The danger to the economy is that banks are now sitting on all this reserves, which if they do start lending it out and the Fed doesn't have a way to actually pull this stuff back out before it accelerates, that's where the inflation overhang
Let me try this again. So let me see if I have this. So right now, banks have a lot of money, all right, because the feds have bought a lot of bonds, banks have sold the bonds, so the banks now have a bunch of cash, and they're saying, now I want to go out and make money off this cash. They do that by loaning it to guys like me to start businesses or to do whatever. But the demand for that money isn't all that high right now. Is that right? Because the economy is stagnant. People don't want to start the new businesses, don't want to invest in this, and it makes pretty good sense with so much uncertainty. We didn't know what was going to happen with Obamacare, who's going to start a business there. We don't know what's going to happen with cap and trade. We don't know what's going to happen with all sorts of regulatory things. Who the hell's going to invest in the tax structure? We don't even know if these taxes at the end of the year are going to, the dividends tax and the capital gains tax, if they're going to go skyrocketing back. Who the hell is going to make a business decision until you know those facts? Assuming we start getting some of that information and businesses say, oh yeah, low interest rates, 3% interest rates, I'm going to go ahead and borrow. I'm going to buy houses. I'm going to buy buildings. I'm going to buy into factory. Are you guys worried about inflation? Because God knows I am. I don't know how in the world you go into this far debt. You put out this much money into the banks, and we don't have inflation. Why haven't we seen inflation yet?
Well, yeah. Originally, again, with quantitative easing, I was originally concerned that it could be inflationary. But given the way the economy has progressed, because there's a lack of demand for the money to be lending it and then multiplying it. If you think of money, the money supply kind of as two things: at the base, as you mentioned, which is sort of a stack of bills. Okay, but the other side of it is the velocity. So how fast is that money churning? Okay, well, if you took the base of money we have now and you started churning it very fast by loaning it out, people borrow it, they put it in their bank, the bank loans it out, and that money keeps churning over, that could be inflationary. Okay, that probably would be inflationary. So you would see that's when inflation would start to really crank up. But as long as you have a very soft economy, then I'm not concerned about inflation for the near term, the foreseeable future. I don't know about you, but I'm not concerned about it in the near term.
I'm more concerned that with all the things that you talked about that have created excessive uncertainty to businesses. And that's that we haven't got that. And those things aren't going to go. That we're really, yeah, that's essentially created in the term, Robert Higgs, a great economic historian, refers to it as regime uncertainty. And economic growth and economic recovery are driven by entrepreneurs seeing opportunities, being willing to invest funds and hire workers, take risks. And in this environment with all those things you list, that nobody is really willing to make plans out 2, 3, 5 years and take the risk in there. And as far as the money and the inflation aspect of it, I think we have, you get 2 to 3 years out, and I think we've got more of a risk of a 70s type stagflation than we do of the type of collapse you were talking about in there. And the real dilemma facing the central bankers, and John Taylor, Thomas Honig from the Kansas City Fed are very, very pessimistic that as we've put all these reserves in the system, that we will be able, as the economy starts to recover and if it recovers, to pull enough out to keep kind of an orderly without the recession.
Let me put this into higher gear.
It's called the exit strategy, and I'm not sure they have a good exit strategy.
I need you to get away from academic mode and into fast talking mode now, because we're gonna get faster here. Let's talk about the tax cuts. The tax cuts that expire at the end of this year, assuming they don't get renewed, particularly the capital gains tax and the dividends tax and the higher taxes on higher income people, I'm assuming that only slows down our economic growth. That really, when people are looking at investing in something, who are they going to invest knowing they're going to pay 15% on their dividends, but now they're going to pay 25%? Well, that's a whole bunch of people who aren't going to invest. Should the Congress pass these tax increases on?
I think we need to renew the tax cuts, and we need to do it quickly, because I agree.
Which tax cuts are the most important in your mind?
Well, I think we need to renew the quote middle class tax cut. That definitely needs to be renewed, and I think sort of the idea of everything over 250,000 households over 250,000 their tax rates would go up. I think that number's probably too low. That needs to be higher.
When you say higher, I mean before
$500,000. So if you're going to, and this is where I tend to fall more on the Keynesian side, is the notion of what are the people who are earning over $500,000 a year? What are they going to spend their money on? If you let them keep all the tax money, and not raise their taxes,
keep their own money.
Keep their own money. What are they going to spend that money on or invest it in? We've already established that there's not a whole lot to invest in. There's not a lot of confidence in investing in the markets. They're not going to go out and buy, necessarily buy bigger homes, more cars, as opposed to what are people, for instance, if you're going to try to get the debt down, the federal debt down and the federal deficit down, something has to give here. And so if you're going to take the money, the other issue today is eliminating unemployment benefits. Okay, that has to be dealt with very quickly as well. So if you're going to, you could eliminate unemployment benefits, spend less money, leave the tax cuts in place, or you could raise taxes a little bit on the wealthiest and keep the unemployment benefits in place.
What are the tax cuts what are the most important tax cuts to keep in place?
Any analysis of tax cuts and effects on the economy should start with the incentive side and the supply side, and how do they affect production.
And
therefore, I think my view, and I've had a letter in the Wall Street Journal, is that one of the things that I think contributed to the timing and the severity of the recession was the uncertainty of the tax cuts even back at the time was hanging on there. People didn't know what they were going to do.
It's not like they had 10 years to figure this out. This is a brand new problem.
It's really almost criminal that the Congress has let this uncertainty of the tax codes
need to be renewed.
Right now, the entire 2003 tax package needs to be renewed, and it's better if it's permanent rather than a temporary, which is one of the proposals in there, because that would then take off one of the major uncertainties that is holding back
the dividends
businesses.
tax